Welcome to Module 6. Module 6 is one of the topics which is focusing not necessarily on African countries, but on multinational companies or corporations, as we call them, MNCs, their tax avoidance behavior, tax evasion, and natural resource management of the continent. Therefore, there are a lot of sensitive issues that we are going to discuss in this topic or in this session. The session has important building blocks which are highlighted in this slide. The first one is contribution of natural resources to national government revenue or the fiscal budget. The second topic is on policy challenges in natural resource taxation. Third, we have multinational companies, capital flight, illicit financial flows, which are topics extensively focused as a policy area by ECA in recent years, with high-profile former president of South Africa leading the production of a very influential IFF report, which is being popularized extensively. We will also look into the tax avoidance, tax evasion behavior of multinational companies. And the fourth topic that we'll be focusing on will be contending with the IFF. And finally, we provide some policy recommendations so that the capital flight or the capital outflows out of the continent can be returned back or also managed in future without attracting any further unnecessary outflows out of the continent. I will provide some background information to highlight the extent and the degree and the magnitude of the problem. There are a lot of financial flows of Africa, and most of them are detrimental to the development of the continent. Over the last 50 years, for instance, if you look at estimates, the loss that Africa experienced it was in excess of $1 trillion in IFF, and every year we lose about 50 billion because of capital flight, illicit financial flows, and this money could have been covered and used for financing needs for several economic, social problems of the continent. Therefore, this is a lost opportunity for Africa to mobilize vital financial resources for its sustainable development. Africa needs for sure resources for structural transformation, and much of this can come by reducing the capital leaving the continent. Therefore, we need a lot of strong regulatory and institutional rules in place to curb this unnecessary and undesirable outflow of finance out of the continent. The illicit financial flows and the capital flight problem is facilitated by a colluding behavior between big business and politics or African governments themselves. Politicians and big international companies have been looting the continent for a long period of time, and this is bringing unbearable suffering to the majority of poor Africans. And this is well documented in many reports. The natural resources sector of Africa is very rich, and we have oil, we have minerals, we have vast forest resources, but Africa should benefit from it, and so far it is not benefiting from these resources as much as it should, mainly because of the collusion between businesses and weak institutional in the public sector. There will not be sustainable development and inclusive growth in the continent if the mismanagement of resources continue in the current circumstance. For instance, if you look at Chapter 6 of Economic Report on Africa, on Table 6.1, there are facts which highlight the grim reality of poor resource revenue collection. Natural resource revenue is one source of finance which can be used to develop Africa. And natural resource revenue is defined by IMF as follows. receipts collected by government from natural resource sector through diverse tax and non-tax fiscal instruments. Therefore, as we have highlighted in our previous discussion, you see the importance of tax as well as non-tax fiscal instruments to generate as much revenue as possible for the development of Africa. And the definition continues as follows. For example, natural resource revenues include common taxes such as the corporate income tax that companies should pay, value-added tax on sales, special taxes on the sector, such as the resource rent tax on forests and other mineral resources, and other quasi-tax and non-tax instruments, such as royalties, mineral royalties, for instance, profits, and bonuses. So the natural resource revenue is one of the very, very useful source of finance for Africa's economic development, as well as its social development for achieving the sustainable development goals in a few years' time by 2030. There are many policy challenges, and actually focusing on the policy challenges really gives us a better and comprehensive understanding of the challenge surrounding capital flight, tax evasion, tax avoidance by big companies, and IFF. There are multiple fiscal instruments in different countries. These are all complex, overlapping, and confusing tax policies and regimes, and even very complicated tax codes, which are changing from time to time. This make revenue collection from natural resources or companies which are working in the extractive industries very, very difficult. Some countries use royalties and some estimates of net income to determine revenue collection. It's not clear why some countries are abandoning royalties, which are easy to administer, particularly on natural resources such as minerals. And they are effective to recoup what Africa deserves from its mining and other resources and other rights it gives to big companies and global players. Some governments are using corporate income tax to good effect, but there is complexity surrounding the determination of the rate that should be applied and the timing of payments by companies. Therefore, the policy should really focus on how much should be collected. It should be clear there, and the rate shouldn't always be to encourage big companies to come and work in Africa, but at the same time it should be a fair rate of taxation that should be collected, and the timing of the payments should be also respected. Otherwise, fine should be there, and the money that is collected should be assigned for development purposes. However, income-based taxes such as corporate income tax are subject to misreporting and underestimation. Therefore, if this is the case, again, there is a possibility that Africa will be missing out from a potential source of good finance for development. The second important policy challenge in the area of natural resource revenue collection is the fragmented and uncoordinated nature of institutions. It's not clear who is responsible, for instance, to regulate the mining, the forestry, and the oil sectors. In some countries, you may have separate units focusing on separate resources. You have a mining industry, a separate forestry ministry, or an oil ministry. And they have very clear mandates whereby the collection responsibilities are outlined. But in many cases, we have a confusion who collects mining royalties, who collects royalties associated with forestry resources, and also the oil sector. Therefore, this fragmentation creates an opportunity for multinational companies and big companies not to pay their due in extracting natural resources from Africa. The third policy challenge in relation to the collection of natural resource revenue and management is poor regulatory frameworks. As far as there is lack of coordination among ministries, there is also a lack of understanding who should regulate which sector, whether the mining, the forestry, or the oil sector. I provide an example here. For instance, the Ministry of Petroleum or Mining usually leads in negotiating exploration, development, and extraction agreements about the natural resource under its jurisdiction, which can mean that agreements are negotiated and concluded without sufficient participation by the Ministry of Finance or the tax administration. Therefore, the unregulated nature of institutions, coupled with a poor regulatory framework, again creates an opening for multinational companies who come with smart accountants and lawyers to exploit the opportunity and deprive Africa of the natural resource revenues that it deserves to collect. Tax incentives, we have said a lot about this in the past, are the fourth policy challenges. Research or the existing literature already shows that investment in the resource sector in Africa is exploitative. Therefore, providing excessive tax incentive is not a useful way forward. However, we should emphasize the following point. Tax incentive should be given to multinational companies, big companies, but it shouldn't be excessive. That is where the point lies. And giving excessive tax incentive doesn't also even benefit, because the literature still and the research still shows us that we cannot attract massive amounts of foreign investment by just trying to beat your next neighbor in Africa by providing a better tax incentive. Therefore, it is going to be counterproductive for long-term investment attraction. Therefore, tax incentives should just be sufficient, and that optimal level should be determined. Investment in the resource sector by multinational companies is high, and it is also based in innovative technology areas, and it rarely benefits the local labor force. Therefore, it doesn't really show us in terms of benefiting the long-term development objectives of Africa. Therefore, the excessive giving of tax incentives can be just counterproductive. The fifth challenge, policy challenge, relates to tax certainty and fiscal stability clauses. This should benefit both governments and investors, and they should lead to a fair business relationship between them. Tax certainty encourages private investment by enabling potential investors to accurately assess the tax and compliance costs associated with an investment over its lifetime. So if there is a mining agreement for 20 years, the tax responsibilities and the burden that the multinational company should face should be clearly laid out, and that shouldn't change without further notice or advance notice. Therefore, it should be certain, so companies should make sure that they are paying what is really determined by the government at the beginning of the agreement or the investment agreement, depending whether it is an investment agreement of 5 years, 10 years, or 20 years. Therefore, that certainty is useful for government and useful for multinational companies, because everybody will be clear who pays what at what point. And tax certainty is also strengthened by fiscal stability clauses in contracts, which are designed to prevent excessive changes to the tax code. Therefore, that predictability should be built into the tax incidence or the tax burden that is going to be agreed at the beginning of the investment agreement. However, fiscal stability clauses may undermine revenue collection, since they prevent host governments from renegotiating contracts to reflect improving fiscal regimes or to benefit from rising commodity prices. So this is a fundamental point. The points that are mentioned here relate to the potential to renegotiate contracts. For instance, if the value of the mineral that the big companies are extracting in a given African country is rising, if the price of a given mineral increases, The tax responsibility should also rise with the rise of the price, because the benefit that the company is going to get will be higher. Therefore, there should be a clause, there should be a paragraph, there should be a text in the agreement which enables government to open the contract again and renegotiate terms based on prevailing commodity prices. Therefore, in some cases, some savvy countries, some very wise, smart African governments are negotiating existing mineral and natural resource contracts with big international companies. So that opening should be there, with the provision of stability in terms of responsibility to pay taxes. Countries should also be able to renegotiate existing resource contracts with multinationals when new information about income and profit streams come to light. So it's not only with regards to commodity prices. And for instance, if the price of gold and copper rises, foreign company benefits and a fair distribution of that benefit should be recouped by the host economy, in this case, an African economy. And governments have to implement this by front-loading such possible changes while negotiating contract initially and make provisions for renegotiation to take place, as I highlighted. So this is a challenging area. There is a resistance for a renegotiation, but if it is embedded in an agreement, in a legal text, at the beginning of the signing of the long-term agreement with a multinational company, it should be possible. And this is an area that a lot of attention should go to. Now we will discuss illicit financial flows, which are illegal practices by companies in collaboration with some state units. That is really robbing Africa of vital development resources that could be used for economic and social development of the continent. In this case, I will highlight two fundamental public finance concepts in the area of the study of taxation, tax avoidance and tax evasion. Tax avoidance is not illegal, and companies exploit legal loopholes to avoid paying taxes. And it is defined in your report on page 125 as follows. Generally, tax avoidance is used to describe the arrangement of a taxpayer's affairs that is intended to reduce his tax liability or her tax liability, and that although the arrangement could be strictly legal, it is usually in contradiction with the intent of the law it purports to follow. And if usually big companies have very, very good accountants and very strong legal teams and solicitors, and there is a very, very smart accounting engineering or tax engineering that will go on to reduce the tax liability of the company that they work for. Therefore, if there are weaknesses in the institutional setup in some African countries, they will exploit it. So resource-rich African economies, mineral-rich African economies should really make sure that the legal loopholes are closed. Otherwise, if there are legal loopholes, the accountants and the lawyers working for multinational companies for sure exploit it. And that happened a lot in the past, and it is happening currently. Tax evasion is outright illegal activity, and it is defined as follows on page 25 as illegal arrangements whereby liability to tax is hidden or ignored. Even if the company knows that it should pay, it doesn't pay. And this is outright theft or crime. That is, the taxpayer pays less than he or she is legally obligated to pay by hiding income or information from tax authorities. So not declaring income completely is considered as a tax evasion activity. Locating your company in offshore locations, such as the Bahamas and the Mauritius and other tax havens, or British Virgin Islands, is going to be considered as a practice which is aggressively pursued by many companies to evade tax or to commit this offense. So that leads to a lot of lost money for the continent. Illicit financial flows are broader. They are not only covering tax evasion and tax avoidance, but they include a lot of sophisticated international financial transfers that are illegally acquired, transferred, and used, as well as aggressive tax avoidance. Therefore, they can include money laundering and other capital movements across borders. Illicit doesn't necessarily mean illegal, but the harm that base erosion, profit shifting, aggressive tax avoidance, and aggressive tax planning by good accountants do to development justifies considering them as illicit flows because they are morally wrong. Examples of scandal by government officials, for instance, includes inflating the value of procurement contracts and depositing the proceeds in a foreign bank. So that completely escapes Africa and escapes the continent and makes it lose the potential to use or allocate the development finance that can promote social welfare. So it is important, as this slide shows, to see how illicit financial flows are channeled from one country to another country or across international borders. We have mentioned some of them, but now we go deeper into each of them and discuss them. The first one is aggressive tax planning. As you have heard me saying already, there is a lot of accounting engineering going on, and there are a lot of sophisticated accounting practices that are used by professionals employed by companies. So aggressive tax planning is often carried by sophisticated financial engineering operations, and this is done well by lawyers and accountants in the world famous consulting companies, and multinational companies can afford to rely on their services to limit the tax obligations that they have on the foreign operations. So host economies in Africa suffer a lot. A good example and discussion is provided in the Economic Report on Africa. If you go to Chapter 6, Box 6.1, you will see or find very useful information on aggressive tax planning. There is also a technical term that is useful to keep in mind, the second one, which is going to be used as also a means to transfer illicit financial flows out of Africa. It is called transfer pricing. Multinational companies manipulate the prices of goods and services traded between different parts of their multinational group with the aim to shift profits to jurisdictions where corporate income taxes are low. Therefore, they report their profits and income higher in jurisdictions where corporate taxes are lower. And they use a lot of financial secrecy. And in this case, as I mentioned, you just register your company legally in an offshore location such as Mauritius, British Virgin Islands, and so on. There is also misinvoicing. That is a third important way how individuals or traders or businesses use this misinvoicing technique to transfer finance across continents. Misinvoicing transactions is a common one. Natural resources and commodities are susceptible to the intentional manipulation of invoices of goods and services, exports or imports, to disguise their true value and evade taxes and custom duties. Therefore, you just when you misinvoice, you often underestimate the value of the good and the service that you provide. Therefore, the tax is always proportional to the value that you have reported, and you often pay less than what you should. In that case, you are committing what we call tax evasion through misinvoicing of trade transactions. There are further channels that we need to discuss. The fourth channel is overvaluing deductible expenses, inflating the liabilities or the losses. So you pretend that your company is struggling by inflating its liabilities. This is by just increasing the expenses that you have, and by showing that your revenue minus expenses is going to be a very tiny proportion on which you are really liable to pay taxes. Again, through a relationship between multinational corporations and their affiliates, you do this overvaluation of expenses. For example, firms may inflate costs on loans. Yeah, if you are paying a loan at the rate of 7% APR, you just say, "Oh, I'm paying 10% on this. Therefore, the interest payment is 10% instead of 7%, which is a real one." And you also inflate costs on technical services, consultancy services that you get acquired from related parties, and overstate your expenses. Then by the time you deduct expenses from revenue, the profit margin will be very, very narrow and small, and you pay less tax. And number 5, there is also what we call treaty shopping and locating asset sales in low tax jurisdictions. And this is a very common technique so that you pay low taxes. Treaty shopping has reduced corporate income tax revenue by about 15% in African countries. Therefore, it's a huge loss. That have signed a treaty with an investment hub, a particular blow to countries with a high dependence on corporate income taxes. And there are examples. For instance, Mauritius, which has received attention recently for facilitating treaty shopping, took steps to address this by revising its double taxation agreements with India and South Africa in recent years, which is 2015. And multinational companies also in the natural resource management sector can avoid taxation in resource-rich countries by routing asset sales through low-tax jurisdictions. Again, this is just emphasizing the point we have already made. Now, we have identified policy challenges. We saw how the illegal or the illicit financial flows are channeled or transported or transferred across borders. It is time to reflect what we should be doing to stop it or to end it. Maybe the ambition to end it is a bit unrealistic because it usually exists in some way or in some form to a degree. Therefore, reducing IFFs is the most realistic ambition that countries should have. Because I don't envisage that the 50 billion US dollar annual loss that we have through IFF is going to be stopped suddenly. I think we should aim at reducing, and we should be serious about it. There are encouraging efforts to combat IFF, and we discussed some of them. And some of the efforts, and most of the most effective ones, will be the efforts which are global in nature, because we say that there are transfers between countries, and there is a capital flight or illicit financial flows out of Africa to other countries. This happens only if two parties are agreeing. Therefore, if the effort doesn't come from the countries whereby these multinational companies are based, such as the OECD, the Rich Country Club, the efforts that we really designed to combat IFF will not succeed. Therefore, some of the encouraging efforts that has originated from rich countries themselves. And they really saw that big companies are eroding the development finance potential of Africa, and they say we should do something about it. And African policymakers, African ministries, African officials also bite this idea, and they are determined to make change. And this is highlighted in the IFF report of ECA, and also by the different initiatives that OECD itself has embarked on. OECD has what it calls base erosion and profit shifting package report, which set out a 15-point action plan to implement the changes to help governments with the domestic and international tools they need to combat base erosion and profit shifting. Therefore, they can have a better handle on the multinational companies which are working in their jurisdiction. For BEPS to work, transparency and data are critical. Therefore, African governments also work in the area of transparency and data collection and demanding it from multinational companies. In rich countries, multinational companies are protected. In Africa, there is a collusion with rich country companies, which leads to a loss of vital financial resources which can be allocated for development in the continent. Therefore, the base erosion and profit shifting package initiative is a very encouraging one. And the second important initiative that is designed and IFFs is formulatory apportionment and a move away from BEPS is difficult to implement due to the income payment. This is due to the likely incomes by multinational companies. IFF is a transparency effort. So there is a new global standard for automatic exchange of information for tax purposes, and this is endorsed in 2014 by the OECD. So what does this transparency effort include? It calls for jurisdictions to obtain information from their financial institutions and automatically exchange that information with other jurisdictions. Therefore, there is less possibility for a given company to hide its proceeds elsewhere. Therefore, what it reports will be reflected in another jurisdiction and it will be compared. So there is less hiding of income, less hiding and shifting of profits. This common reporting standard, which is called the automatic exchange of information for tax purposes, can help tax administrators to clamp down on companies that hide or withhold information relating to undeclared offshore funds. Africa has a long way to participate in this system, which is based on reciprocity. Therefore, there should be a collaboration and a coordination between African countries and a foreign country for this automatic information exchange. Participation in this system should be a very, very big priority for African governments. Most African governments lack the capacity, the infrastructure, and the resources to meet the administrative requirements and bear the costs of participation in the system. Therefore, in some cases, if there are funds allocated for development finance or technical assistance, I think a smart policy will be to focus on those resources on building administrative capacity so that they participate in this very, very vital initiative. And there should be a trade-off of participating in this system and the benefit that it is going to bring in terms of curbing IFF. So at any cost, I suggest, or we believe that African governments should participate in this system because there is a lot at stake. They can really prevent or reduce the IFF, which is leaving the continent annually. $50 billion is not a small amount of money. It is a huge development finance resource. Unfortunately, so far, only 3 African countries, Mauritius, South Africa, and the Seychelles, are participating in the system. And the resources and the natural resources that are being exploited from Africa are not necessarily only from these 3 countries. They are from many, many other very resource-rich African countries. Therefore, and only one other country, Ghana, has passed a legislation needed to really take part in the first step of this information exchange participation. And this is a big gap area, and we need to work as Africans to really take this seriously so that IFF is reduced. Thank you very much for listening to me, and we have now left with only the last module, which is on Africa's growing debt, and next time we will discuss that and conclude the recording of our course.